Can you explain the shorting of futures and why these may be chosen over put options?
Obviously, we have a number of capital protection tools at our disposal, and the one is put options and one is short selling. And so often you may see us choose to short sell futures over the portfolio rather than buy a put option over the portfolio. The main reason why you may see us choose one versus the other is really because of the volatility environment. So put options work very well when volatility is very low or when the VIX is very low. And that's something we obviously saw leading into COVID. But put options don't work well when volatility is high. And that's something we saw over the US election where the volatility is too high. And so the payoff diagram or the payoff outcomes is just not as good. In that scenario, sometimes you just want to raise some cash, but you don't actually want to sell the portfolio and buy it back again. So you just effectively short futures and assume that the futures will correlate quite strongly with the underlying portfolio. And when we look at like the NASDAQ, for instance, that is true for our portfolio, or the S&P 500, that is reasonably true for our portfolio. And so those are instances where we choose to short futures rather than buying a put option.